a lot of people, they recognize you have to use different strategies for different markets. So is this kind of a, you mentioned volatility being up and using spreads. I assume credit spreads?
To the extent that you can, yes. I'll do a lot of debit spreads here, quite frankly, though. I will be committing a lot less cash to buying stocks and a lot more cash to buying option spreads, where I'm owning the right to buy something at $45, for instance, selling the right to somebody else to take it from me at 50 or at 55. So I've been putting on a lot of that, especially in the Chinese area, because of what we've discussed. If they're going to throw, call it $500 billion or $1 trillion at their markets and their banks, I'm going to ride along with that. So I'm long KWEB, which is, Chinese internet stocks. Some people might kind of look at it a little bit like the NASDAQ of China, but FXI kind of covers all of that, the S&P and the NASDAQ of China. So I like both of those. KWEB will move faster, but FXI is, a broad swath of those Chinese stocks. And I own a lot of those ETFs because I'm more comfortable owning a little less or a lot more diversification in China and a little less of the stocks in China.
So what do you think about the power that's come in the last couple of weeks here into these China stocks and these ETFs?
Well, I'll give you one, Arusha, that you'll love, and that is if you took a look over the last month at NVIDIA, that's everybody's darling, right? Oh my God, this is Jensen is the next coming of Jesus or whatever.
NVIDIA can do no wrong.
He isn't, John.
Well, it was up as of a couple of days ago. It was up 6.5%. It's probably up 4.5% now because it fell back some into the teens. But the Chinese stocks were up 27% or more.
That's true.
Over the same period. So again, and I'm not just looking back, I'm looking forward. I'm still long. I've been rolling up in KWEB. I've been rolling up in FXI and rolling up. What is that? Well, if I own the 30s in FXI and then it goes to 32, I'll take the profit on the 30s and buy the 32s. And if it goes up to 35, which it has, or 36, I'll buy the 36s, take all that other money off the table, and then start putting on calls against it, start doing that spread 35, 40 or whatever like that, because I think it gives you great opportunities. And the best opportunities right now, I think, are energy and China.
So using that strategy, are you keeping your expiration date the same or are you extending that expiration and how far out are you doing?
I am usually right now in the November options and December options. But I am not doing the calendar or the diagonal spreads, if you will. I'm not, in other words, folks, I'm not long out in December and shorting options in November. I could be doing that, but the volatilities didn't tell me to go that direction, so I didn't. If the vol is highest and highest by a lot in the short dated stuff, that is what you want to sell and be long the longer dated stuff. So if I get a big disparity between those two, I will do exactly what I just described. But if I don't, then I'm just saying, okay, that money is going to start flowing in. These banks and consumers are going to start spending it, going to start investing with it and so forth. So TAL, education play, EDU over there, JD over there, so many of these BEKE. I mean, there's so many of these plays that you could put on over there in China. And most of them, even after these moves I described, 27% or more, most of them are still way down for the year.
That's true. So, John, with a number of these stocks and ETFs, were you seeing a bunch of unusual options activities starting to come in over the last few weeks?
Yep. Starting about 2.5, 3 weeks ago, we saw a flood. We saw like 50,000, 100,000 calls being bought in primarily, Arusha, in the indexes like KWeb,
Yep.
like FXI, like ASHR, which is like, I guess, their their blue chip index
Interesting.
for
Yeah.
China or something like that. But there
Yeah.
are so many different ETFs for China. But the biggest ones were those three. And by far the most volume was in FXI, followed by KWeb.
Mm-hmm. And I have to just say my apologies, because I'm looking at the YouTube chat here, and someone was bemoaning the fact that they sold their YNN, which is a leveraged in China. They sold it a couple weeks ago before all this happened. But so John, like right now, I mean, this just looks like such a strong move, and a lot of times people would be concerned about buying extended, or are you more likely to have a pullback? How do you kind of protect yourself from that with your option strategies?
Well, and we have seen a lot of pullbacks, believe it or not, even in these China stocks. I mean, of course, in this hemisphere, we're trading after they've traded in China.
Right.
Because the way the world turns, folks. Quick science lesson here. And the way the sun rises. So what we end up with is that the big moves happen in the pre-market, and sometimes that can fade all the way back down. And if it does, it just kind of frustrates some people, but I like to be patient, so it's good for me. So what I'm talking about is seeing a double-digit gain in the pre-market for PDD, 2Ds, PDD,
Yep.
Penduo Duo, I used to call it. I'm not sure what they call it now.
I think they just say PDD.
You just get to say PDD now.
Yeah,
now that they're an Irish company.
Yeah, Justin stole it from me. Yeah, they are now headquarters in Ireland, so they're a great Irish company, John.
Yeah, they are. Well, you'll see that one open up 10% higher,
Right.
and then fade back to basically 1 or 2% on the day.
Wow.
I don't know who the people are that are selling it, but then the next day it just does it again, and they're playing for a break, obviously, here on our side. But there were articles that I saw, perhaps even in Investors Business Daily, that were talking about how a lot of hedge funds are getting carved up, not just because they're short in China stocks, and many of them were, but also because they're so underweighted in China that when it makes a move of this nature, again, 6% for NVIDIA and 27% for China stocks, you're underperforming. You're missing your various global benchmarks by a ton. Yeah. And so you're having to scramble to try to get some of that back.
Mm-hmm. Now, with such high returns, there's no free lunch, right? You get higher risks. So you mentioned that you were, that you have to be a little bit have some patience with these. So how do you what do you use as kind of a stop loss in order to protect yourself in case it goes south on you?
The same one, Justin, that I always use, which is I pray. No.
Hope.
But what I do is if whether it's a spread or whether it's an outright purchase of an option, if the spread loses half of its value, I close it, move on to the next trade. If the option loses half of its value, close it, move on to the next trade. I'm sure Arusha, being a portfolio manager over there, would say the same thing, that it's not about making money. It's about not losing big on the wrong picks you make. Definitely. Because we all get caught on the wrong side with timing. I could show you a dozen trades in the last month that I've had that, my options expired before the move happened. Sort of like your friend in YNN, where that wasn't the issue, but they traded out of it before the move happened. That can happen to any of us. So what I try to do is, if the trade isn't working, if I bought a spread for $1.50 because it could go to $5, the difference between 35 and 40, $5, I paid $1.50 for it. If it goes to 75 cents, I'm out. It's not that I say, oh, I'd put more money in at 75 cents.
Right.
That's gambler's ruin, folks. Happens all the time at the tables where Arusha and Justin just were. But You don't want to do that,
Yeah.
especially if it works once for you. Because if it works once for you, it will spoil you. And you'll think, oh, well, I'm going to double down here. That's not
incentivizes bad behavior, right?
Yeah. Nobody on Wall Street that's got any years under their belt does that.
Yeah.
So
go ahead, Arusha.
Yeah, so we were talking about in the beginning, where especially like in August 5th, where when the markets are really coming down, a lot of times you're going to sell premium into that volatility, right? You're going to sell it and cash in that way. To the upside, when you're in some of these stocks, or I mean, I know you're rolling up the options. Are there any strategies that you'll use to just sell some premium into some of these extreme moves?
There are, but I rarely sell naked options.
Okay.
I will sell,
which is good. Yeah.
Yeah, I will sell covered calls.
Okay.
If I decide that I have a relatively small number of stocks in a portfolio, Arusha, where I do covered rights, and they're Microsoft, Nvidia, Apple, Google, Meta. I mean, I'm pretty heavy in techs, I guess, if you want to say that, in that space. And then I'll just overwrite them with calls every single month just to collect rent. And on times like August 5th, I will pull off all my other hedges and start hammering in on that high vol, because I might be getting 40 out of a stock that I usually get 22 vol in. Well, in simple terms, that means I'm getting twice as much premium for that month. Or usually I'm writing options that are just 1 month out. So I'm getting twice as much premium for that 1 month. I like telling newbies that that's as if you had an apartment in Vegas during Formula One week, or in Monaco during Formula One week. You don't think those rent for a lot more during that week? They do, or the Super Bowl or whatever. So that's, a gift when you get that big volatility, and I like to take advantage of it.
So you also mentioned that with a lot of these option strategies that you're using, you've been doing a lot of rolling, so you buy and then you just roll it to the next strike, or I suppose eventually you'll have to roll it to a further expiration. When do you decide to do that rolling? Because I think that's the $1 million question, right? When do you do the roll?
Okay. This is my strategy for rolling, folks. When I follow somebody big into a trade in the first place, and I never know who they are, but I know their size.
So when you say big, you're seeing some big unusual options activity come in? Is that what you're talking about?
I'm seeing 10,000 options, 5,000 options, 100,000 options in the FXI.
Not your Aunt Sue down the street, right?
Yep. I want to run in the same direction that those guys are running. And so then, to Justin's question, but how do I know when to roll, or if I should roll? If that open interest starts slamming down, guys, the open interest, of course, is all the contracts that have been exchanged up until that date at that strike price. So when you see a 10,000 contract open interest, okay, there's a lot of trading at that strike. Well, now if that starts going and it goes down to like 2,000 or 500, you know that whoever bought those is selling like crazy, because they're reducing that open interest. And in that case, I would not roll. I would just take the trade off and move on. On the other hand, like with FXI, great example, they bought when it was 30 and they rolled up to the 32s. They didn't close the 30s. They just still had them, but they rolled up to the 32. I'm going to roll up and out to the same expiration that they picked. And then if they don't close that and they just keep rolling up and rolling up, which is what they've been doing, they did the same thing in Nvidia. These big traders tend to be somebody who's on a trading desk, and the portfolio manager is saying, look, I need more exposure in XYZ. And they go out and get it fast by buying 10,000 options. You can buy 10,000 options quicker than you can buy 100,000 shares of stock. And 10,000 options represents 1 million shares of stock. So
Right.
that portfolio manager worries that he's going to, or she is going to run the market if they step in and buy 1 million shares of stock. So they have their guys buy me a bunch of calls out there in, November timeframe or December, Christmas, they call it. Buy me Christmas at the monies right now. Boom. They're going to put that trade on, and then they're going to keep layering in with stock as well, and then start trading out of some of those option trades as we get closer to the expiration or closer to their price target.
Yeah, and that's interesting. I'm going to bring up Joe Fahmy again, John,
Yeah.
here. But for when we were at the Founders Club, that we were talking about this topic of how institutions use the options to quickly build those positions, just like what you were saying there. And I think that, I mean, I think I need to say that again, just so people understand. It's not always the institutions going into the regular market and buying stock. This is just a much easier way for them to build a position and really accumulate it if it's really working over time.
Yeah, and they get the leverage just like
Yep.
all of us do. So
Mm-hmm.
that's the good news. And you want the leverage. I mean, you're a hedge fund for a reason. You want the leverage. For the retail investors, they just have to understand the leverage so they don't take too much.
Yes.
Hedge funds are rarely taking too much. They're very tightly regulated by both the head of the firm as well as their prime broker. But you guys, not Arusha and Justin, but you guys watching this need to be very judicious in how much leverage you put on.
Right. And I mean, when we've seen in the past those hedge funds, those companies that blow up, I mean, long-term capital management back in 1998, they went over leveraged, right? It was, they kind of snuck under the radar of, this very safe trade with this, that will only go wrong in a black swan event. And then you have a black swan event and they're toast, and it doesn't matter how many Nobel Prize winners you have on your team, no one can escape the over leveraged position, right?
And it would have been okay if Russia hadn't closed. I mean, for instance, long-term or LTCM happened, folks, because there are firms that do trade globally and they put constant risk on globally. Well, if all of a sudden a big part of your market closes and doesn't reopen for days or weeks, you're screwed. Because whether that the rest of the world is going up or the rest of the world's going down, and usually it closes because the rest of the world is going down, you can't get any hedges off in that. So you're going to have a big loss in that one particular pod of all these different time zones that you're trading in.
Yeah. One other question though, because certainly there are those folks that are, again, institutions using the options for leverage, but sometimes they're actually wanting to get the position, right? So they're using options to kind of get it quickly. And the hope is, or the intention is to exercise the option. They want to be assigned the shares, depending on which instrument they're using, a call or a put. Does that kind of change the math if you start seeing like that open interest just kind of stay there right up until the expiration?
It kind of changes what could happen on expiration day. Now, somebody doing just what you described, Justin, is not going to change their stripes going into expiration day. They didn't hold that thing to expiration to then try to trade out of it in the last 10 minutes of the day. They do want that stock, long or short, puts on the short side, calls on the long side. So they want that stock if they've left that position on all the way into expiration. Otherwise, they will have rolled it 9 times out of 10 or even 99 times out of 10, the institutions would roll into that final week of trading if they hold it that long. Usually they know very well what we all know about time decay, and they don't want to be the chump that's the subject of time decay. They'd rather let somebody else be that chump, and so they'll trade out of it with 3 weeks to go, 2 weeks to go, and they rarely are riding them right into expiration.